Hello there, this is forexbrokers.net, and this video starts a series of 3 videos dedicated to contracting triangles. Contracting triangles in technical analysis have a long history. They belong to the classic technical analysis patterns, and they may be continuation and reversal patterns. The concept of a contracting triangle evolved in time, and Elliott Wave's theory uses many types of contracting triangles. So we have a lot to discuss here, and I also want to have a look at some examples both on the current price action and on the past, so to see how to interpret triangles. Triangles are of 2 types: contracting and expanding, and contracting triangles are more common than expanding triangles. When the market, for instance, moves to the upside aggressively, and then at one point in time it consolidates. Usually it consolidates with 5 segments. Elliott used letters to define the segments of a triangle: A, B, C, D, E. And the way to interpret a triangle, or to see the triangle, is to draw the so-called B to D and A and C trend lines in order to see the shape of the triangle. If the 2 trend lines will contract, then the triangle is contracting. If the two trend lines will expand, the triangle expands. So this would be, let's say, wave A. Let's make it a bit bigger, change the color to make it more like this, wave A. And then if we use another letter here, this would be the B wave. I'm only labeling these ones not because this has anything to do with the Elliott Wave theory, but it is easier to understand the concept of a triangle if we use the labeling as Elliott intended some years ago. So A, B, C, D, and the E wave, A, B, C, D, E, like this. And if we draw 2 trend lines that connect the B to D, let's make it of a different color. Let's try to change it like this. If we draw a trend line, the B to D, and then the A and C trend line like this, we see that the triangle, or the price action, contracts into the triangle. So A, B, C, D, E, this is just a consolidation before the market moving higher, because this is the end of the E wave. According to the Elliott Wave theory, a triangle is broken by the time that the market breaks the B to D trend line. But it cannot break the B to D trend line like this. All you gotta do is to measure the time that it took the market for the E wave to form, take that time and project it on the right side from the moment that the E wave ended. For the triangle to be valid, the market must break the B to D, or the price action that follows the triangle must break the B to D trend line in less than it took the E wave to form, in less than the time that it took the E wave to form. And that is a valid contracting triangle. Otherwise, that's not a triangle. This rule, and this is why we started with this rule applies to all contracting triangles. This rule applies even to expanding triangles. Imagine an expanding triangle. In an expanding triangle, the B to D trend line and the A and C trend line will part. They will not meet somewhere on the right side of the chart. Instead, they will meet somewhere in the left side of the chart. When the two trend lines finally meet, imagine that we have the extension of the B to D trend line here and the extension of the A and C trend line here. This point is called the apex of a contracting triangle. This point here is called the apex of a contracting triangle. It is a very important level. What traders do is they use this level for future support and resistance level. For instance, if the market breaks higher, up to the triangle, by the time that it comes to the apex level that we already know from the previous contracting triangle, and by the time that it comes at the apex, we know that the market should react. So if we are on the short side, we should at least book some profits or trail the stops or tighten the stop to better manage the risk moving forward. This is a contracting triangle, but triangles, they are also contracting triangles when they form against horizontal base. This is called a horizontal symmetrical triangle. So this is called a symmetrical triangle. A symmetrical triangle, but triangles are also forming against the horizontal base, and this current price action on the euro-US dollar speaks for itself, in the sense that the notion of an ascending or descending triangle changed in time. They were invented on the stock market in the United States, but from that moment on, financial markets evolved, and volatility on the currency market is much bigger, much higher, not bigger. And therefore, it is rarely that you will have exactly an area or a level where the market will react from. But if you use a trend line, a similar trend line like this one here, if you use it and you consider it as the A and C trend line, and you consider this one as the B to D trend line, then we can see a triangle. How would you label this one? Well, I would go something like A, B, C, D, E, and then the market moving lower, probably visible on the lower degree. This is called a descending triangle. It is still a contracting triangle. But it descends. The apex of a descending triangle or an ascending triangle plays the same role as explained earlier, providing support and resistance. Triangles are everywhere, but triangles can also act as reversal patterns, not only as continuation patterns. So stay tuned with the second part. Remember, we have 3 videos on this topic. Stay tuned on the second part to discuss triangles as a reversal patterns. Bye bye.